Good afternoon or evening, everyone. Welcome to the Top Tier Outlook. We do this show every Sunday to get a jump start on the week ahead. We'll take a look at the open. So the Asian session has just now opened at 6 p.m. Eastern. We're going to take a look at where we are in a very early look at the week, as well as what we have in terms of different events coming up this week. It shan't be a boring one. So first of all, let's talk about the first thing we're going to deal with. This morning in Asia, right, it's 6 p.m. on the East Coast of the U.S., but this morning in Asia, the S&P has opened up at 56.89. It doesn't mean that that's where we're going to be, but it just continues to, there's 2 points here that we need to talk about as to where we are. I think there's two ways also. Let's talk about the 2 points. I'll talk about the 2 ways we can look at the market. And if you get these right, it's going to make trading a whole lot easier. And I emphasize trading. I don't mean 6 months from now, 6 years from now, even 6 weeks from now. Most of us are trading with a 2 to 10 day time horizon. So let's embrace what it is we're actually doing. All right, so let's get to the first point. One, we're in chop. So anytime any symbol is in chop, like the S&P is right now, there we go. See? Now, where we are right now is ultimately a spot on the chart that tells us what? It tells us where resistance could be. Now, I'm using a continuous contract here, which is to say, if I'm looking at a continuous contract, what it's telling me is where we are in terms of where the S&P is, regardless of the contract month. Oh my gosh, give me 1 second here to quiet my phone. All right, so what we want to remember is if we look at the transition throughout the year, there are 4 contracts that we're looking at the S&P. But also keep in mind, because every one of these contracts is associated with a delivery month. I know that sounds ridiculous, delivery on the S&P, but remember, futures contracts were born of things that we consume, like oat and wheat and oil and whatnot, right? So there's a delivery month. But think of it this way. Where do we think a certain contract will be as it ends? So think about that again. Where are we going to be as a certain contract ends? So right now, if you take a look, the optimism around the December contract, which is the Z contract, is quite high. Now, we're in the U contract, which is September, but it doesn't really matter, right? I know a lot of folks get caught up with, but we change contracts. Remember, we're still measuring the same thing. It wasn't as if the previous contract was the S&P 400 and now we're looking at the S&P 500. No, it was the September opinion, the September contract delivery of the S&P versus the December. So as we look further and further out, as we are going from September to December, we're bullish, right? We're bullish. So folks say, Rog, what do you think about where we're going to end this year? I don't know where we're going to end, but clearly the December delivery contract, again, remember that expiration, that contract is telling us we're optimistic. Now, there's a lot of things to remember about any kind of gap. Number one, this Friday, let's talk about the event. So I said there was 2 things we need to keep in mind. Number one is this is chop, right? Number 2 is it's bullish chop, but we can definitely see a lot of strength here. There's a chance that obviously, as we get to what's known as overbought in a choppy environment, how often do we hear overbought and oversold? Well, it's great languaging, but it's specific only to, right? It's specific only to chop. So the way I look at something that's oversold at support or overbought as resistance, I never really consider that in a trend because trends are inherently imbalances. So the 2 things we're looking at is a lot of bullishness, but we're at the top of the range in a choppy environment. So am I a bear up here? No, I'm cautious up here, right? I'm cautious here. So take a look at the previous resistance levels. We have a high. Now, remember, as we look at a continuous contract, when I point out this July 16 high, that was part of the U contract. But we don't go back looking at the year saying, oh, but that was March, right? Or this was, this is the March contract, and this was the June contract, and this was the September. Now it's the December. Now, when we step back, we look at it as the S&P, and it's a continuing opinion about where the S&P is going to be, right? So that's the first thing. The second thing is anytime we do have resistance, I'm looking at this July 16 high at 57.21 and a quarter. And I'm also keeping an eye on the August 26th high at 56.69. So in this area, I would not be surprised at all if there's some selling pressure. Now, first thing on a Sunday evening, what is this, 4 or 5 minutes into the session for the Asian Open, I'm not going to make any, big decisions about what this gap means, but it does tell us a lot about expectations about where this December S&P is heading. Still pretty darn bullish. All right. That's the first thing. The second thing is, what could make us change our minds about the value of the S&P as we're sitting up here. Now, this doesn't matter if I was looking at the NASDAQ. This doesn't matter if I was looking at the Dow, the S&P, the Russell. Each one of them are made up with their own stocks, their own sectors. The S&P is just the coolest way to look at something that reflects a little bit of the NASDAQ and a little bit of the Dow, right? So it's an interesting mix of the two. As we go through the week, Monday is probably not going to be a very big deal with the Empire State Manufacturing Index. Tuesday is probably not going to be huge. However, because this is a consumer behavior related data release on Tuesday the 17th, core retail, home sales, consumer sentiment, the even employment, anything that measures what the consumer is buying, if they're buying, how much they're buying, what they're buying, and if they have jobs. These have definitely taken the upper echelon of our attention. What used to be pretty much inflation and inflation only has become, hey, what's the health of the consumer? Are they employed, and what are they buying, and how much of it? Right. So this would definitely be in that consumer behavior, consumer employment type bracket, right? Core retail. So we'll keep an eye on that one. Now, normally I'd probably say that might be a major event for the week, but we have the FOMC on Wednesday. And this is where things get interesting, because if you're looking at this as a potential inflection point, and all I mean, gang, is we just could simply be overbought and retrace back into the range. Now, I cannot emphasize enough the lunacy of looking at this high and predicting that we're going to go to 5,100 or 5,000. How about if we make a retracement about 50% of the range? We'll take a look at that. Folks call it a half back. I'll look at it at a 50% retracement of the current range. If we hit 5,400, well, it's near-term support. It's support that we bounced off of this month, right? Okay, so let's look at it within the framework of where we've been before we start painting way outside the lines. And remember, there's a whole business dedicated to painting outside the lines and putting together scenarios that are horrifying and scary and everything else. It's there to grab your attention, right? Because if these folks had any clue as to what they were talking about to begin with, they'd probably be telling you, when they weren't busy trying to scare you up here, that we should be buying the dips for most of the previous 8 months, where 5 of the 8 have been bullish. What a concept, right? Okay, so we know we're in chop and we're at a specific inflection point. Now, what could trigger the psychology of selling, or frankly, more buying? That comes to a head on Wednesday. So on Wednesday, we have the Fed funds rate, right? On Wednesday, you can see here, we're going to finally get that result on the decision. And there was a lot made, a lot of hyperbole on Friday about the fact that the 50% basis point expectation has surged. This doesn't mean we're going to get 50 basis points or half a point cut. It does mean, and this is kind of confusion. This is not good. I would be far happier going into Tuesday's close, Wednesday's open, with this 500 to 5 1/4 column, the tallest, and over 80. Why is that? Because that would have been certainty. Once either one of these columns gets over 80, that can usually be considered fully discounted. So if you're wondering, how do we measure expectations around the Federal Reserve's decision on Wednesday? This is it. This is uncertainty, gang. It's a coin flip. Right now, Fed fund futures are saying that pretty much 50% we get a half basis point cut. It's 25. It's 50% we get a 25 basis. This is the Fed's nightmare. This is not what Jerome Powell wants to wake up to this Sunday evening or Monday morning. This is not what he wants to take a look at as the markets are waking up, because now he's realizing, oh gosh, right? They don't know what we're doing. And it's his fault. It's their fault. 100%. They create their own problems, but they basically put themselves in a situation where the investors and traders out there are saying, we don't know what you're going to do. We know you're going to cut. We just don't know how much. Problem is 50% of the folks are expecting a half point. 25% of them are expecting a quarter point. If we get the half point, it's a double-edged sword. Why are they cutting half a point? Is there something they know that we don't? How bad really is it? That's exactly what will happen about 5 to 10 minutes after the jubilation of the half point cut. Oh, wait a minute. This could be bad. I mean, they're reacting so much. Clearly, there's a lot going on under the surface that we may not know about. And there'll be a slight concern even with that kind of cut. It would be far better if we just get the quarter point cut. If this column by Tuesday's close or Wednesday, even noon, is up near 80, where folks just say, look, let's just expect a quarter point. And then that is what the Federal Reserve will give us. That's going to be far easier. If we're still in this 50-50 area, come Wednesday, it could be very volatile. And that volatility is going to be what? Well, if you've got a lot of folks expecting a half a point cut and they get a quarter, what are they going to do? Buy? No, they're going to sell, because their expectation, their response to that was to buy bonds, buy the S&P, buy the NASDAQ in this expectation of a much more dovish reaction, right? Favoring lower rates. That's dovish. If we get that, that's going to be where we get the pullback, right? That would make perfect sense. That would be a catalyst. The 25% cut would probably trigger, if expectations align more clearly to it, a buy the rumor, sell the news. Now, does this mean collapse, crash, bear traps, or whatever people are talking about? No, it just means we're in chop and we're overbought. And we finally reached a point at which it makes sense for folks to either take profit or not be as bullish in the near term about new highs. That's it. That's it. So some of this gap could be that look at the Fed fund futures, where that 50% expectation has surged at the later part of last week, which really, frankly, is not what we want. Because now the Federal Reserve is thinking, what do we do? Either we're going to disappoint a huge bulk of the investors and traders out there because they're expecting a half and we're only going to give a quarter, or we have to give them their half, right? Do you see the confusion? And that's where we are. And when we look at, here we go, when we look at bonds, same thing. Remember, gang, we're going to be rolling over on bonds, but I don't make a big deal about rollover. I want to acknowledge that options expiration, triple witching is this Friday. It's the end of the quarter. So this isn't your garden variety OPEX. This is the big one. It's the one we get 4 times a year. And there's a lot more volatility usually associated with it. But bonds have been continuing to climb higher. Bonds are up a little bit, right, this morning. And bonds moving higher actually indicate lower yields. Lower yields are what you get when the Federal Reserve cuts rates, right? All right, what's another place to measure? The 6E. 6E is also going to roll, right? So roll meaning before the contract actually expires, before the contract is done, which is going to be Friday, the traders and investors, they leave the old September contract and they start trading the December contract. Okay, that's all. That's all that a roll is. It's what is the sentiment associated with September and what is the sentiment or opinion associated with December, and the chasm is the roll. But at the end of the day, really, when we look back over the year, we're not parsing between, oh, this was the March, this was the June, this was September, we're not. At some point, it's just the S&P. But there's a much more intense view of it at the roll, because a lot of folks look at a roll and say, well, we need to close the gap. We don't have to, right? This notion that gaps must close and gaps must close immediately is actually wrong. They could close. We don't know when they're going to do it, but it leaves this hole in the chart, like a window that's open that wants to be closed. The timing of it, nobody knows. But what we're trying to look at is the calendar to say, well, if there is a catalyst to want to close that window, what would it be? What would the catalyst be? And I'm pointing out some of the ones that would do it. Obviously, FOMC, with the confusion going into this week, would be a big part of that. All right, so we get past Wednesday, right? And the sun still rises and the earth is still spinning. I know. And we get into unemployment claims. Not as big a deal. It's a weekly number, but there'll be some volatility. And then come Friday, we get a little bit more FOM speak and some ECB speak. So clearly, when you look at the week, it's very much about Wednesday. It's really about what is it that we're ultimately get. But more importantly, it's really about where does this particular graph, the September 18 target rate probability, where is this sitting into Tuesday's close, into Wednesday's open, and in front of the 2 p.m. Eastern decision? We'll have to keep a really close eye on this. And that's where we are right now. Choppy market up near the highs, could be overbought. And if there's a catalyst for whether that's the 6E, whether that's the ES, whether that's the YM to sink back down into the range, we have a reason for it. And what we're seeing now is the difference between where September's contract was and frankly, the optimism for now around December's, where the only reason December is a gap up is because traders do expect the December contract to continue to be strong and stronger than the September contract was. That's the difference between December and September. All right, so let's take a look at some questions here. And I think that covers a lot of the questions that I saw coming through. What would be potentially creating a little bit of a pullback? What that pullback could be a 50% retracement of the current range. It could be a retest of 5,400, right? We just don't know. But we want to look at what it could be. And I like to split ranges in half. And then I like to look at the support of the range, because the range tells us where price has been. And if we can associate, by the way, some volume with those ranges, even better. But we'll know that as we progress through the week. So ultimately, when I'm looking at what we have open, and I'll share with you, these are the positions that we have open, right? These are the open positions that are swing trades in the sector secrets mastery. And we closed that IBM. I have a lot of September 20 options expiring. All but 2 positions are going to expire on Friday. So I'm actively managing the winner, that is Coke, Gold, RTX, XLP, and Schlumberger, Johnson & Johnson, and financials have a little bit further out of date. So you can see these September 30, October 18, and October 4. So that's where we sit there on the swings. And I'm bullish. I'm still very bullish. I have one put open in terms of a position in anything, and that's Schlumberger, because of the weakness in crude, oil services, and energy stocks. Other than that, I'm an unapologetic bull. And again, if you look at Schlumberger, you can see why I'm bearish. But if you look at something like Coke, you can see why I'm bullish. And again, we're 9.5 months into the year. So let's talk about the first 8. 5 of those 8 were bullish months. We haven't really had any bearishness in terms of a longer term trend this year, except for when there was confusion about what the FOMC was going to do in terms of rates. A lot of chatter that was nonsense from certain Fed members, not named Powell, who talked about rate hikes in April. Some of you might remember that. That's my one negative month this year, by the way. So far, 9.5 months in, that was my one negative month. April was very difficult. You might say, Rog, was August bad? No, August was actually terrific because we were in mostly staples, utilities, Coke, things of that nature. And when the concern with the yen crisis came around and the carry trade, right, defensive stocks did just fine, as you can tell. So August wasn't anywhere near a problem because at that point, the posture through September, or I should say this posture through summer into August, September was far more defensive. Still is, by the way. XLU, XLRE, XLP are still at the top of the list in terms of strength. And by the way, GDX is up there with it. And we are gold bulls in the mastery as well, playing the long side of gold, playing the long side of miners. And we're looking to start playing Newmont mining specifically. So if you want to put those on your watch list, I would definitely keep an eye on those. All right, so I see a lot of the questions about the Federal Reserve. Line watcher, Imanu, yeah, that's exactly what I'm expecting. That's what I'm watching. All right, Sandu has a question about CRWD. That's not a name that I would put on my watch list, Sandu. As far as what my thoughts are in CRWD, it's in the bearish hemisphere. It's not particularly strong at the moment. I would keep an eye on some of the support and resistance levels there, but I don't have a setup here. But I think more important than that, Sandu, of all the things that I could trade, This is what I always ask myself. It's the process we go through in the mastery of all the things that I could trade, of all the futures contracts, currencies, indices, treasury, stocks, ETF sectors. Why would CRWD, why would any symbol deserve my attention and my capital? And usually it's going to be because it's clearly bullish or clearly bearish, that I've got a healthy trend, and then that trend has alignment with the index sector stock or the commodity sector stock. And I can't say CRWD would end up on my list for that reason. But I would keep an eye, if you're looking at the long side, maybe keep an eye on the 243 level for support near term. All right. Gone to Earth asks, what helped me overcome the fear into getting into a trade? Preparation. Gone to Earth, preparation and making my own decisions. Trading is not about mirroring me or anybody else. It's not a blind trade along. Confidence comes from understanding what trade is being put on and then putting the trade on, seeing it working. So you're going through this loop of understanding, testing it out, and seeing it works. And you just keep going through that process again and again. But preparation and understanding the setup, which is why we do these shows, which is why I get into the why we're trading what we're trading conversation so much in the mastery. This is why we're so transparent about the watch list and what I'm doing day after day. In fact, this recap that I'm sending you, I send out every day to my mastery members so they can know where we're in from, what we have, where and what price. And this is in addition to the alerts that I send out. So preparation, and if you want to think about it, comprehension, right? Do I understand what's happening, or am I just thinking to myself, oh, so-and-so is a really great trader, so I'll just follow them in? Please don't do that. Nothing about our service is about, the way I run the mastery, it's a mastery. It's not the sector secrets mirror what Raghee's doing thing. Although you certainly could, but it's designed to teach you while you're putting on the trade. Because frankly, a lot of the indecision that I see traders have is because they don't understand why they're getting in or why they're taking a loss or why they're taking a profit. They don't understand. They're just kind of following along with what they think they're supposed to do. And that's never going to map to what I know everybody here wants, which is understanding what they're doing and account growth. Right? We all want those two things. So ultimately, that's the way in which, Gone to Earth, you need a process. You need a mentor and you need a process. And when you're able to do the process again and again, you're able to understand it better, is the hope. And then you'll have your own confidence. You'll have your own understanding. And the fear just really starts to fade away. Look, by the way, Gone to Earth, every time I get into a trade 32 years later, I still get some butterflies. That is healthy. That means I respect what the market's capable of doing, and I haven't deluded myself into thinking that just because I want to be a buyer, magically everything's going to work out, right? That's why we have stop losses. That's why we have position sizing rules and understanding the risk to the account and the risk to target, right? So I'm always thinking about what if I'm wrong. So yes, we should be a little bit of butterflies, but it shouldn't be fear. And fear usually comes from not understanding why we're doing what we're doing. All right. So I hope that kind of helps in terms of what we're doing, what I've got, and what I want to continue to do. This week will be tricky because of FOMC, and I will continue to focus on where the trends are, which kind of comes back to the simple thing, kind of coming full circle. Do I have to trade the S&P? I don't. I need to know, do I have to trade the NASDAQ or the Dow or the larger averages? I don't. Can I trade the outperforming sectors within them that are stronger? There are sectors within each one of these that sometimes look better than the index itself, right? There are also sectors that have nothing to do really with what's happening in the NASDAQ, the S&P, the Dow, the Russell. And these are commonly known as the defensives. And I would throw gold in there as well. We don't have to trade the S&P. We don't have to trade NVIDIA. We don't have to trade Tesla or Microsoft or any one of those magnificents. In fact, I'll even say that's not where the winners have been. So focus on where the trends are, know where the hot zones are on the calendar, and let's see how this week goes. As always, gang, thanks so much for being here for our top tier outlook. If you want to see what we're doing over in the Sector Secrets Mastery, you can check it out over at sectorsecrets.com. And if you haven't already, pencil in September 2-4. September 24th, 8 p.m. We're going to walk you through the trades we've been putting on in August, the trades we've been putting on in September. We're going to walk you through some of the SPX testing that I've been doing for 6 months as we add that into the Sector Secrets Mastery going into the last few months of the year. So I'll see you there September 24, 8 p.m. Have a great rest of your day. I'll see you tomorrow for Charts and Coffee. All right, be good to each other, gang.